All right, well, good afternoon, everybody. Welcome to our fifth and final session of our Successful Investing One inaugural main event conference uh, with the nickname of the COVID Cancellation Conference, which many of you have. You're hoping that this isn't an annual COVID thing, that we can actually get that behind us. But trust me, we will continue to explore and consider doing things like this. I wouldn't be surprised to be a successful investing too at some point in our future, not too far down the road. And we would like to do this as long as we can be meaningful and continue to discover and share good ideas amongst all of us. That's what this conference has really been all about. Uh, it was basically the genesis of the conference was the fact that so many of us had been canceled out of events all around the nation. Ken and I had trips to St. Louis, Philadelphia. Future trip to New Orleans is uncertain. Anyhow, all those events are just kind of stacking up, and we miss you guys. And so we decided to put this together and see how things would go. It's been kind of experimental. Please tell us what you liked, didn't like. If you have any suggestions for future considerations, please let us know. But let's go ahead and get things underway. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by five of the best investors that I've met in the last several decades, and I'm just really honored to call all of them friends. From left to right, Kim Butcher, formerly of Evansville, temporarily down in Florida for a few months. I believe Kim is on the line with us. Were you able to get all the way in, Kim?
I'm here, and I just think that our creative juices need to get flowing so that when we have to do the next conference, the theme should be CCC and get new terms there.
You bet. We'll do the best we can. Now, I don't think Pat Donnelly is actually in the room. He may have snuck into the back room. Pat Donnelly from Pittsburgh has been a contributor here. Ken, thanks for all that you do in the realm of investment education, as well as Cy and Hugh. Thanks to all of you guys. Thanks for doing this, and let's go ahead and get underway here.
I do need to clarify I'm not wearing a tie.
Well, for those of you that missed the last session, we went around and asked who was wearing pants. So, all right.
And Cy, if you're not wearing pants, we don't want to know. Okay.
Okay, I will keep that to myself.
I'll just withhold any comment that I have on my hideous khaki shorts. You guys all know this drill by now. No investment recommendation is intended. This is about the demonstration of a method, a philosophy, and that's why we come together to lean on each other and learn, and again, fully deploy 80 years of a pretty successful approach to the challenge of long-term investing. In fact, I think long-term in investing is kind of a conflict of terms or redundant. We could leave out the long-term part. Let's just talk about investing. By definition, it's long-term. We'll talk about some real companies here, real time. So again, do your own homework, come to your own decision. We'll try to disclose if we actually have a position in some of the companies that are discussed. Again, as Ken just said a few minutes ago, if you'd like to be added to the reminder list, email nkavula1@comcast.net, and we'll let you know whenever we're gathering in this type of fashion, be it roundtable or other theme or topic for discussion. If you would like a copy of the slides to any of these sessions, or if you have a follow-up question, send me an email, markr@manifestinvesting.com. I'll forward it on if necessary, take my best shot at answering. We'll do our best to take care of it. All right, we're down to the fifth session. Thanks, everybody. It's been fun so far, and I think this is one of the more entertaining and engaging sessions that we can, where we actually share where some of our favorite sources of ideas come from. So let's go ahead and get underway. I just threw this one in here because I don't know, Rod Serling was a topic of discussion a few weeks ago on social media, and I just think that's a nice little quote. I used to have a lot to do with Research Zone at Better Investing Magazine. It's kind of a soft spot in my heart. So the Research Zone, and that's what we're going to actually dive into cue the music. You guys all know the music, and we'll dive into it. Here's just a little bit of a thematic outline. As you know, Ken Kavula will not allow me to do a presentation without an animal in it. So I went with the red rabbit on the slide. But we're going to be talking about screens. One of the things we do at Manifest Investing is, although we've taken a few months hiatus, every Friday we come out. We've been running kind of a back test or foretest. I'm not even sure what kind of a test you would call it, where we reach into our universe of good and excellent companies, and then we subject them to a secondary screen. And you can see the results there on the right. Some of these are going to come up in just natural discussion as we go through some of our favorite screening devices, and we'll go ahead and close with the one at the top. Right now, since I have the microphone and the keyboard, I'm going to go ahead and rely on my favorite investing resource website in the world, Manifest Investing. At Manifest Investing, you can run a pretty quick stock search. I've referred to it as the Ivory Soap screen. If you go into our screener, basically what the Manifest rank is that you can see up here on the upper right. Let me go ahead and grab my Madden pen. This Manifest rank is just simply the combination of the two most important characteristics that we believe are fundamental to any company, and that is the company's quality and the return forecast, or the projected annual return. Those two factors are basically equally weighted and then stacked up in kind of an index, and we just simply go in and say, give us the top. We actually put in the number 99.44. This is where Ken teases me about nobody remembers what that is. If we were a live audience, I would ask for a show of hands if you remember the 99.4% pure Ivory Soap. So we're actually looking at the top 1/2 of 1% of the companies that are in our 2,400 stock database. And the list is actually a little bit disappointing to me. It speaks to the market, and I think Sai's going to go there here in a minute. Has some comments to that regard. Normally we see quite a few community favorites on a list like this. And right now, and it's something we might actually talk about during the Q&A, there's an awful lot of banks showing up. And I think that's a sign of the condition of the current market. But again, with just entering that one factor, letting it go, we'll demonstrate it in a little bit. You get a pretty good list of companies to study for further analysis. With that, let's turn it over to Sai.
All right.
He's disrespecting my soap here.
We're going to go beyond soap, or maybe get soap out of our mouths, we could say. And actually, that was an interesting Ivory Soap screen, because if you look at it closer, you will notice that a reasonable number of those companies have less than stellar financial strengths. And I think two things are going on here. Number one, the combo rating puts a lot of emphasis on par, and these somewhat financially more questionable companies in this market of flight to quality have higher pars, so that's bringing them in. And then, of course, remember that the quality rating, which in more normal times would screen out many of those lower financial strength companies, also do have a profitability, earning stability, which also is reasonably low in this screen, but also has growth in it. So I think really there it's the out of favor, slightly lower quality companies, and I'm talking relative terms because these are still all excellent overall quality things that are slipping in. So anyway, jump back to my screen. Frequently, the difference between the Ivory Soap screen and this screen is that you're going to kick in some of the yellow pars, the potentially too good to be trues you'll see in some of the results. You'll bring those in, which you don't usually see in the Ivory Soap screen. And it will also include a few more companies because it's just a little bit broader screen. But I keep it simple. My normal basic manifest screen is I look at the sweet spot. In this case, 5 percentage points above my par. My par is 12.4%. That's 17.4. And I usually just round it down to the lowest level to show me a few stocks on the board, or also actually manifest rounds off the numbers. So the funny thing is, you put in 17.4, you may miss some companies that actually show on their screen as 17.4 because of rounding. Normally, I do quality of excellent or good, depending on market conditions. The past few years with very high market conditions, I tended to have 80% quality there. For purposes of today, I relaxed it to 70 since we're in a bit of a down market. So I still think that's very good quality, and you'll see the impact of it because the screen is very flexible in results. But then I put excellent financial strength of 80. Again, sometimes I slide that to 70, but right now, particularly with the 70 overall quality, I wanted high financial strength. But essentially, that's my basic screen. Here are the results. And I usually don't get much fancier than that screen. I've done it some over the years, but most other things I want to do, I can do by ranking. You see here, this is the screen ranked by par. As I mentioned, you do get some of those yellow stocks in there. You're not normally going to see that in the Ivory Soap screen. Again, those aren't necessarily a void. They're just realize that the assumptions may be too good to be true. So you want to just look closer at them. But what I like about the screen, and we'll see it in the next screen, the next slide, but you can sort by any of those columns. So you may say, gee, I want very high quality, good returning companies, but I also want to see what the earnings stability. I want up straight and parallel. I don't want bouncing around. And you see there are a few Facebook, for example, has a 51 earnings stability, the lowest company. Simon Property Group, a 34 at the top, 34 earnings stability. So those, but rather than putting that in as a criteria, you could simply click on earnings stability and you'll get your companies ranked that way. So this is a very versatile screen. Usually the column that I next sort by, sometimes it's quality, but I'll go ahead and go to the next screen, Mark, is growth. In this particular market, I think most of our portfolios could probably use a little bit more growth in them. That's certainly true of the Roundtable portfolio and my Better Investing Growth Stock Outlook magazine model portfolio. And so you could sort by growth, and there you see from top to bottom the growth rates. Notice 31 companies total past the screen. That's a little on the low side, particularly for a market that's not bouncing up against all-time highs. 21 of them were excellent quality. So if I had used kind of my standard go-to of 80, I would have had 80 for quality. I would have had 21 companies pass it, and then there are 10 that are in the good quality. So that's the Beyond Soap Still Simple screen.
Thanks, Si. All right. Now, over the course of the weekend and again over the course of the years, you've heard us talk about the triple play. I don't think Ken Kavula or Kim Butcher get out of bed without thinking triple play every day. So, Kim, if you'd like to walk us through how to look at a company for a triple play, we'd appreciate that.
Oh, I'd be glad to, because I've kind of made a lot of cha-ching with the triple play, so I'm real fond of it. George Nicholson had said that when you can find a stock with a triple play, it's like all the tea leaves are giving you the same story, and that's great. And the triple play consists of, if you look at a value line sheet, you look at the projections box where you have number 1 on your screen. And if you look down at the bottom there, your projections are 20% there. So it's over 10%. That's great. You want to have a PE ratio. If you look at there where number 2 is, the median is 16. The trailing is there, and the PE currently is 11.7. But going forward, this company is going to have a PE all the way down. If you where Mark's drawing that red arrow for you, it's 15. So when you have PE expansion, PE is two things: earnings and price. And that means it's correlating, number one, the depressed stock price and the earnings. So they're going to go up. So number two, meaning the PE ratio is low, below its average, it's going to move forward, expand, and that's going to make your stock price expand. So that is another cha-ching thing to look for. And those companies who can keep their margins and those profit margins consistent or improving. That means they're squeezing out another penny out of every penny that's fallen to the bottom line, and they're making money. And you want consistency because that shows that they're really, really good at it. So look at how this company is improving. And I would almost say that I don't even know which this company is. Another way is look how it at 6.8 and 3.7, I'd almost hazard a guess. In here, this company may have had an acquisition, and look at how the solid line above in the picture that's up above, or the dots are, where you have your projection box is showing you the low of 60 and the high of 90 on the far right hand side. That solid dot, Mark, if you can circle that, yeah. See that 60 to 90, that's over on the far right of the value line sheet. The solid, the dots to the side, the 60 to 90, that's where they're projecting the stock price to go. And Mark, circle that solid black dot that's on the graph.
Oh.
That's where the stock price, yeah. That's where the stock price is, and that's a simple way when you look at value line, the way they show it, they think that this stock is undervalued. So the Nicholson triple play shows you where the stock price could be depressed, and now it is your job for research and judgment to find out why it is depressed. But it's showing that the company value line and their rhythms, their analysts feel that this stock price could expand, and that means the price will expand.
Good stuff.
And that's why I love that triple play.
All right. Just some quick reinforcement. This is basically one of the screens that we put out at Manifest every once in a while, where we basically display what Kim was just talking about, the high return forecast along with positive improvement in PE expansion and profit enhancement. And again, that can be quite fun when we get that all lined up, as Kim says, ka-ching. All right, switching gears. Hugh, would you like to describe a little bit of your Irish approach to screening?
Yeah, I was just going to show a couple of tools. I'll show the first one. I think it's going to be on the next slide. It's probably very familiar to people because I've used it for quite some time. I think it should be slide 12.
Oh, I switched around the order. I put the FinViz stuff in a little bit.
Oh, okay. So just talking general. So it's interesting because in days gone by, there were very few screens available. So, and I assumed, of course, that people were going to talk about Manifest Investing Screen, which is a really powerful tool. I like the approach. And the screens that are available actually on most brokerage websites, which is more than what you might need. TD Ameritrade has nice tools, as does Charles Schwab, etc. But what I'm going to show later are some tools that I look at in general. But the one thing that I found to be exceptionally valuable for me is the 52-week low. This is for a core holding company. A lot of the work in getting a good return is done in buying a company with a good earnings engine when it is at or near its 52-week low. I started doing this in the 1990s. I used to call it feeding the children when I was reinvesting dividends. I used to feed it to the kid that was most hungry, and it showed that it was most hungry. It was trading at a low. It needed more food, if you will, to bolster it and make it grow again. But it turned out to be quite a good tool, and I've discovered that there are some legends in the investing world that actually have followed this approach for 80, 90 years, well, maybe 70, 80 years to great effect. And then for mid-sized companies, if I can get a 3-year low, I love that. And for these very high-risk companies, the mid or the small-cap companies, I look at 5-year lows.
Yeah,
and like to buy companies when they're there.
It's good stuff. I would recommend. In fact, there's a couple articles by you on the Manifest website where he goes back and captures what Ken Janke used to point out about the every single year the low price is like 50% of the high price for the year.
Yeah.
And why not buy it when it's down around the low price? And Ken used to follow that pretty diligently.
It's the way to do it.
Good stuff. Thanks, Hugh.
I hope that's not a picture of me on the next slide.
No, this one is. We'll let Kim describe this one as a opportunity for ideas. Go ahead, Kim.
Yeah, I came across and found out that there was a book called Stock Under Rocks, and Mr. Rashidian out of Tulane University out of New Orleans wrote the book, and it's talking about, the book literally says, as Manifest Investing has always said, and Better Investing, you need to have small cap stocks in your portfolio because they can give you outstanding returns. Well, there it is, and you can see that they have a Hancock Horizon Berken Road small cap fund, the HHBUX. But I use that as a fishing pond to go look in there, because every year their students have a fall and a spring conference, and these students are in their master's program to learn how to be portfolio managers, and so they do a write-up on a company, and they only pick 5 states to choose from around Louisiana, Georgia, Florida, Mississippi, and I'm not quite sure who the other one is.
Texas is probably
Texas. Yeah, Texas. So it's a great way to go, try to go looking for a new stocks, because they give you where they think the stock price will be in a year. You can see what the stock price is now, and you might be able to find a small cap stock that's going to be great for your portfolio. And I found it to be very helpful for me. And I send some of these reports to Mark, and then they get added to the database.
You bet. Well, thanks.
Kim, I'm going to interrupt. Would you name that book again with the author?
It's called Stocks Under Rocks, and it's written by Peter Rashidian, Ricchiuti. He is one of the professors at Tulane University for the master's program for portfolio management, and this is one of the few schools in the U.S. that teaches kids in their master's program for management of funds to maybe go on and be a hedge fund manager or work in the industry.
Yeah, I believe they actually take care of at least part of the endowment at Tulane. So hands-on learning going on there. All right, let's go ahead and jump back to Hugh. He wants to share some thoughts about FinViz.
Thanks, Mark. Well, this is a screener that has been around for some time. At one point, when it was less expensive, I used to pay for the service, but I found it a very good screener, and I actually used to use it in conjunction with a tool called the Stock Selection Guide, which is a tool from Better Investing. And it was particularly useful for part 2 of the SSG, where you look at pre-tax profit and sales and return on equity. And there is an approach that you can take with that section where you can carve up the return on equity into its components, or into components. So there's 3 major components that signal profitability, leverage, etc. And actually pre-tax profit and sales is embedded in the ROE when you actually carve it up. It's a really good tool. And so the ROE and the pre-tax profit on sales diverge for some reason. It usually means the company has taken on more debt. But this was a good website to go and carve it up and see exactly what the company had done that caused those 2 things to diverge. But it gives a lot of useful information, and it has some nice mapping tools as well. And I'm just going to show a selection in the next few slides. We'll go through these reasonably quickly. I looked at Aflac. I presented that yesterday in the lightning round as a company to pick. Sorry I didn't buy it at the end of March, obviously, but it shows nice information, a nice plot of the stock price performance over the last year or so. If we skip to the next slide, when there's a button that you click on the right below, sorry, this is not a button, right below the stock price chart, you can actually get detailed information, and this is all free, by the way, on the company, its profitability, its sales, etc. And as you go further along, on the next slide, you can click and, you can click and you can actually look at the screener. So you can select the various screens that you want, and they're up in the middle bar, or sorry, the top bar up at the top, where you can see things like dividend yield, market cap, exchange. And on the next slide, I just show a screen where I'm picking up biotech companies in particular, which is on page 17. And you can see that I looked if they were in the NASDAQ, if they were mid-size, if it looked like the price was going to increase by 30%, the target price the next year, and I wanted to be in the US and over $5. That gave me 16 companies or so to go and look at further. And some companies I've talked about in the past, Fibrogen, I believe, I put in a portfolio. I might have talked about Intercepting Global Blood Therapeutics, which probably needs to change its name. And then on the next slide, so we'll move to slide 18. We can see that it's just an example of all of the tools. The maps are up at the top. I haven't shown that, but it'll show what's hot or what has been developing over the past period of time. And you can select the last day, the last week, the last month, the last year, and get investing ideas from that. If you want to actually pay for this site, I think it's somewhat expensive for what it gives. It's now essentially $25 a month, $24.95, so it's close to $300 a year. But still, it's, as I said, it is a very good tool. I've enjoyed using it in the past. Fairness, I don't use it as frequently as I used to, but I do go back to it periodically.
All right, thanks, Hugh.
I think, okay.
All right, Ken, you're going to give away some of our small company secrets here?
Well, yeah, I would like to draw the attention of, I do a lot of traveling to clubs around my area, and one of the big complaints always is they can't find any small companies, and most of them have access to the tools. What I urge them to do is to open the tool up. Since you're getting it as part of your dues structure, why not use it? Open the core or this is the SSG Plus, and click on the spyglass over on the left-hand side. There's a series of icons. Click on the spyglass. What comes up is the screener, the Better Investing screener. It's a very simple to use screener, and in my mind, pretty powerful. What I like especially for people that tell me they can't find any ideas are the predefined screens. Now in the core SSG, there's only a couple of predefined screens, but in the SSG Plus, there are 5 of them. My favorite is the small company predefined screen, and it just takes one click after you get to the page. It takes one click to bring up a list of 16 or 18 of the best small companies out there. So you click, and here's the beginning of that list. It will appear as fast as your internet happens to be. And there's some really great ideas on this screen right here. I am currently studying in one of my clubs, Essent Group, and we're currently studying Qualis in another one of my clubs. So they're not all winners. They're not all going to make you a huge amount of money. And most importantly, they're not all in the buy zone right now, but they're great ideas for study. And if they're not in the buy zone, or more likely, if you don't have enough cash to buy everything you'd like to, then they're the makings of a great pounce list a lot of times. Take and pay attention to these predefined screeners. Like I said, it's absolutely free with your membership. I'm using the SSG Plus, but even the beginner's tool, the core SSG, has predefined screens as well.
Yeah, it's a good resource. I know that we recently added Gravity to our database. It wasn't in there, GRVY, and I know that Paycom has been very successful over the last year. I think Paycom might be one of our small stocks this year, Ken. All right, Kim wanted to point out a resource available at MarketWatch.
I'm a firm believer that when insiders are buying shares and they're putting their own money at risk, and this is when the insider is opening up their wallet and doing a buy with their own funds, not just where they're getting paid out their shares because they're an executive and they get their quarterly bonuses. I happened through one of my screens finding out, I found MarketWatch has this on insiders. I had read where the director had purchased over $6.5 million worth of JP Morgan shares. And when an insider is putting that kind of money into a company, it makes me want to take a look. I did more research, and the last time this director put money into the stock was, I think, in 2016. And this stock has dropped from $141 to $85. And who's not to say it may drop a little bit farther because of all that's going on, but they believe that they're going to have a lot more bargains to be found when companies start reporting out the second and third quarter. So when you're putting that kind of money at risk of your own money with your own purchase, I always think that is a very good confirmation. It's my confirmation bias that might be something I really want to take a look at, especially where you see in the last 3 months, there's been 15 purchases of the stock, but 9 sales.
All right,
But
thanks,
I think
Kim.
the biggest one is $6.5 million somebody's putting in.
Yeah, that's a chunk of change. And for those, if you're not familiar with MarketWatch, you can get there just by going to marketwatch.com, and your computer will do the rest. All right, here's my one slide reminder from those of you that attended the small company class. We talk often about Brown Capital and the fact that they're the only mutual fund out there with the correctly and accurately titled fund. It's not small cap, it's small company. And they look for companies that are growing in the same way that we do. Again, just go there, enter the ticker in at Morningstar, go to the portfolio, and then allow your eyes to go to that first bought column. And I really would like to pay the most attention to the ones that are 19s and 20s, fairly recent purchases, and just make sure that I've got an awareness, that I've done a little bit of study into these, and Appfolio is showing up in a lot of portfolios right there in the middle of the chart. And I also want to draw your attention to the fact, and this underscores the fact that these guys have conviction. They invest like we do. They, as in the words of George Nicholson, you buy and you hold something as long as it makes sense to do so. So you see things on here like Biotechny. That's a company that Hugh and Ken have loved. They've owned it since 1993. How about Cognex? Also 1993. So again, not a lot of turnover. They stick with their selections. They have conviction, and they think just like we do. I am drawn, as Ken pointed out during the session yesterday, to these just to make sure. Some of these are fairly early stage, but you want to take a look at them and watch for opportunity. Maybe you throw them on a pounce list and wait for them to age like a fine wine. All right, with that, he's going to tell us about Crunchbase. This is cool, guys. Strap yourselves in.
Thanks, Mark. Yeah, Crunchbase is a site that I've followed for many, many years. It grew out of an entity called TechCrunch back in the early 2000s. Back then, small companies desperately looking for funding were finding it hard to get money. And so an organization, a few guys in San Francisco, started TechCrunch. As the name suggests, there was a crunch in the tech market, both biotech and in the dot-coms. And so they developed a website to show who was funding and where was that funding going. And they had a database called Crunchbase, and they eventually made that public. And so I've been following that, and I actually subscribe to it as well. I will give a warning because Crunchbase is best suited for emerging companies. Companies, as I jokingly say, are earnings challenged, but it does have a history of other biotech and early tech companies, where they got their funding from and who gave them money. It shows funding prior to an IPO, so it shows all of the venture rounds, who gave the money, how much was raised. And it's a very good way to piggyback on someone else's due diligence. So if you get to know some of these venture capitalist firms, you'll see their names over and over again, and you know that these guys really do know what they're doing, but you have to realize that it is high tech and therefore high risk, but they generally have a better return than most average investors. So we skip along to the next slide. I'm just going to show you some of the screens that you'll see in Crunchbase, and I get Crunchbase Pro. I'm a subscriber to it. However, I do need to stress that a lot of the information that they provide is free, and you can access oodles of information. So on the splash page, the first page that you see, they'll show how much was funded yesterday. There were 285 funding rounds yesterday, Friday the 15th. Companies raised $8 billion. 76 companies were acquired, and the total value of those acquisitions was $3.4 billion. When they say there's a lot of money about, there is a lot of money about, and there's a lot of money being funded every day for startup companies. And if you've ever wondered, in your mutual funds, you might see in the prospectus a statement that 1% of the assets goes into illiquid investments. They actually mean that they often go to venture capitalists who further invest them in these high-risk, high-tech startups on the East and the West coasts, generally, and that's where most of them are. So we move on to the next slide. What I did here, well, because I've been touting Ardelyx at the round table, I've just selected Ardelyx, put the name in, and clicked, and I've discovered that this company has raised over its life about $300 million. By the way, that doesn't include the funds that it got from its IPO. They're not embedded in that figure. But it shows when the company was founded, who the founders were, and it gives some detailed information on the company. I haven't included everything here. On the next slide, it shows when it went public and how much it raised. It got $60 million itself, so that appeared on its balance sheet in the next reporting period. But the total valuation at the IPO became $238 million, and that was 6 years ago in June. But the thing I really like, and it's shown on the next slide, is when you start to inquire, well, who funded this company prior to its IPO? And so it will break that down, and it will show the VCs who were involved. And again, for most of us, you probably would not be very familiar with some of the names that you will see, because you're just not used to looking at these. But I would suggest for those that are interested in biotech or tech in general, that this is certainly a website that you might want to consider using pretty regularly, because a lot of the due diligence that you might need to do is done for you by other people who are professionals in the field, and it just gives you another thing to look at. So it will show you, for example, the number of rounds that it had and how much it raised. You can see there's a column that shows how many venture capitalists or investors were involved, and over on the right, it shows who the lead were. At one point, it's Amgen Ventures, which is a subsidiary of Amgen itself. Amgen invests, as do all pharma and biotech companies that finally become profitable. They set up venture arms and invest in startups, and Amgen is no exception. But and Amgen has invested in a lot of very interesting and successful companies over its life. But then if you click, and I clicked on the number 10, which was the second to the last or third to the last round, you can see a list of the venture capital firms that invested in this company. And again, I mentioned that you probably don't recognize these names. I got used to seeing companies like New Enterprise, RA Capital, Perceptive, Cormorant, Deerfield, Rock Springs. These are all high quality, high caliber venture capital companies. And when I see them on a list, it warms my heart, and it gives me confidence that maybe the company they're investing in has a better than even chance of actually surviving. But
yeah, Hugh,
for you to build that,
I was just going to interrupt.
Sorry, go ahead.
We talked about Rock Springs Capital during the small company presentation. That's the hedge fund that's run by Chris Jenner, formerly T. Rowe Price, Health Sciences. anytime I see them on board, I'm really thrilled to see them here, Hugh, because I
Yeah,
actually own some Ardelics. I'm
yeah,
thrilled to see Rock Springs on this list.
yeah. And that Eco R1 is a very old VC firm. It's been around for a while. It's a very respected name on the West Coast. It's another very reassuring name. But when you go and look at the Forbes list, so that what if you're not familiar with venture capitalists and who they are, a simple Google search will bring you to websites that you know and trust that have done also due diligence on the venture capitalists. So the venture capitalists will do due diligence on the companies, but maybe some of the websites and trust will do due diligence. You can know who a quality company is and who isn't. So I look to see what venture capitalists invest in biotech, or what are the top VCs that invest in biotech. And I've looked at a number of different websites and just shown two examples here. I tend to know them, but I imagine that if you're new to this, you may not know all of these names. But you will see Alexandria Venture Investments over and over, New Enterprise Associates, which we saw previously. OrbiMed is a very big player in the biotech field, as is Arc Venture. Interesting, Alexandria Venture was actually a real estate company that was building labs for companies on the West Coast and realized, wow, these companies are so well, we should get a bit of that pie. And so now when they build labs for companies, they ask for a piece of early equity in the company as well, and now have a venture arm, and that venture arm is very successful. On the next slide, this is a slide that that I took from Endpoints News. There's a franchise called Fierce. There's Fierce Biotech, Fierce Pharma, if you want to get news on the industry. There's also Endpoints, which is a very good website. It actually was started by people who left the family and started their own entity. Very, very good. But this is from a number of years ago, where they ranked the VCs investing in the biotech field. And you'll see many of the same names here again. I know it's hard to read. One of the challenges we face presenting screening is you try to condense a lot of information into a small space. But here we have companies again, like OrbiMed, GV, Google Ventures appears everywhere nowadays in biotech. And then you'll see Merck, Pfizer, all the big players will be on this list in one way, shape, or form. And then the other thing I do for these emerging companies, be a little bit orthogonal, is I go on a website called cafepharma.com. I hope that's familiar to some of you, but it's a discussion board. Things that should not. So,
Breaking up a little bit.
But you get an awful lot of information on Cafe Pharma.
Okay.
I'll give you one, if I have time. That is, about 10 years ago, we were buying an entity, turned out to be in the UK, and it was all very hush. None of us were given any details of what was happening, but we were told something is happening. And the CEO at the time flew off, all secret, to negotiate the purchase of this company. And I just out of interest went on to Cafe Pharma to see if there was anything on the CEO. I'll not mention his name. So I typed it in, and lo and behold, I discovered where he was going, what company he was looking at, who he was talking to. I even learned where he had went for lunch and what he ordered. And these were employees of the company who were just spilling everything on this website. So when he came back, I had mentioned to my boss what I found out. I was called into his office. He asked me had I looked at confidential files on the server. And I said, no, John, I shouldn't have mentioned his name. I showed him the website. And he thought this was great because he got the employees' true feelings about what was happening, and he got a little bit of an extra insight. But an emerging company, it's not a bad website to review. So yeah, that's a bit of a rushed effort, but Crunchbase, particularly, and to a lesser extent Cafe Pharma, which is not a traditional screening site, but it gives backup information or another perspective.
Very interesting, Hugh. Thank you.
Thank you.
All right, let's spend just a quick moment talking about something you've heard over the weekend a little bit, this concept of relative strength index, and we have started to pay a little bit more attention to it at Manifest and within our community as perhaps an adjunct or something complementary to with respect to entry points and exit points. And again, I'm going to encourage anybody who's not familiar with it that would like to know more about it to go to stockcharts.com. In their chart school, you can actually read all about it. What it comes down to, and what we're talking about here, would be a company being below a relative strength index of 30. For most companies, we use 20. We would be looking at that as a potential buying opportunity. Anytime it gets above 70, and we're going to actually probably use 80, relative strength index of 80, in combination with a low projected annual return or any other problem or portfolio centered opportunity to sell, it's just one more log on the fire, the relative strength index. One of the things we do at Manifest is we watch it on a daily basis. Back in mid-March, we talked about this during the opening session on Thursday evening. There were a few days when it got kind of wild. In fact, the number one stock there does sweatpants and underwear, Gildan activewear. And I was basically looking at this information. By the way, there's no company below 30 now. That's how much of a recovery we've had. But anytime they get below 20, that spells serious opportunity. So I basically said, well, what if I take a list of very high quality companies that could be on our pounce piles and basically see where are the rhinos overreacting and perhaps giving us a buying opportunity. So I'm sitting here looking at this list, and there's some fairly interesting names on here from top to bottom. Some I was actually interested in obtaining ownership of. And it all happened pretty fast. In fact, Kim will remember, we were looking at one of these at lunchtime. The stock price was at 24. I went up, made a hot dog, came back downstairs, and the stock price was at 34. So we had to move on to the next one.
Expensive hot dog.
Yeah, it was a very, very expensive hot dog. So again, the ferocity of this opportunity is something I want to bring to everybody's attention. You want to be in a position to at least monitor for this type of thing. I couldn't move money around fast enough. Let me show you how ferocious it was. One of the companies that was on that short list, I was actually looking at buying some for a son-in-law who loves culinary type stuff. And that's Chef's Warehouse. The stock chart for that, you could see it dropped from 32 down to $2 a share. And it was still showing up on our list as a company that might have some merit. Now, the picture on the right, Kim provided via Ben Carlson, that's a picture of fund managers in their natural habitat. I had no idea that they could congregate like that. Pretty wild picture.
Very handsome.
Yeah, that's pretty close to reality. Anyhow, the point is, on March 20th, put together this screen, the most oversold, again, biggest buying opportunities, pretended to invest $100 into each of them. This is 5 days later, people. Look at what the $100 became and look at the percent gain.
Wow.
So again, it's an interesting opportunity. I'm not so sure we won't get another one of these within the not too distant future. It's just something to be aware of. Again, relative strength index as a screening tool. You can screen on stock charts. The capability will be embedded within Manifest here fairly soon. With that, Ken, I think I'll turn it over to you to describe some of our work in this area.
We've been doing a lot of work on owner's capital. In fact, you can go to YouTube and you can find Rock the House, which is the name of the presentation we did back in the winter. You can see we were all dressed for Santa's arrival during that presentation. But essentially, we've been looking at this metric, which is called return on capital, ROC. That's the formula for it right there. And if you're a little bit algebra challenged or math challenged, we can find sites where it's actually calculated. There is a little bit of dispute about how the calculation is done, and we do notice that it's not a standard calculation source to source to source. So make sure you are comparing apples to apples when you look up this number. Return on owner's capital, think of it as what you're going to return to your pile of cash based on what you put into your pile of cash, not based on the value of the instrument that you purchased, but based on what the ownership share of the purchase is that you've actually put in. If you click one more, Mark, you can see that these numbers vary wildly from a high of 32%, and this is a fairly current screen for owner's capital, and these are all pretty decent numbers for return on owner's capital. I'm sure most of us would be content with even the return at the bottom, which is about 15%. I'm sure we'd take that, especially over time. So we're looking at this, we're calculating it for various stocks that we're interested in, and we hope that we're going to be able to start displaying it to use as another metric to help you pick stocks that are going to add to your wealth and to your nest egg. Mark,
Yeah.
I know you can add a little bit more to it.
Yeah, what I would point out, first of all, it's based very much on the work of Joel Greenblatt. If you want to Google Greenblatt, just like it sounds, Greenblatt, you can get to know a little bit more about him. But again, just think in terms of it literally is no different than a stock selection guide, because that top half is the pre-tax profit in section 2A. And what it really represents to the people who follow this mode of investing is that represents the average return to the owner over the next 10 years. It just happens to be 5 years out. It's the average. And you compare that return again against the total capital or the enterprise value. You know, what does it cost to buy the stock? How much debt is involved? And then how much cash do they have? And it really is the total capital position that you're accounting for. The teaser on all this is all done without touching a PE. So just let that rattle around a little bit. The other thing is it's less volatile than any of the other measures that we have because it doesn't rely on PE. So it's a tighter formation. And this is a current list. It's a couple hours old. And many of the companies that were mentioned here this weekend are on this list.
What intrigues me so much about this metric, Mark, is that it seems to have so much in common with screens that I run that are my favorite screens, things that I look at to draw parallels between stocks I'm interested in and not interested in. And when I go down this list, I say to myself, my goodness, I own 6 or 8 of these companies on the list. I'm very interested in another 4 or 5 on the list. There must be something to what this is telling us, and therefore I'm very interested in the parts of the list that I'm not familiar with.
Yep, so we'll continue to do more work. I'm sure there will be another session coming up, I would say probably within the next month or 6 weeks, where we'll dig into this a little bit deeper, but just so you're aware of it. So with that, I think we're doing pretty good on the time. I think we will shut down and indulge in some Q&A. Just want to close with our typical invitation to the May roundtable, where again, as you heard in the last session, we're going to be talking an awful lot about portfolio-centered selling for the roundtable, just to protect our wonderful long-term performance. And then I also want to issue that save the date. I think I've got that date right. Ken, can you double check me on that? That would be the last Tuesday in July. We will be celebrating our 10th birthday on that date. So make sure I'm right on that date, Ken. And
28th of July, is that right, Mark?
Yep. And then obviously we're going to have some fun with that. This has been quite a run, and we're going to have some fun. Again, for copies of slides or follow-up questions, my email address is there, markr@manifestinvesting. If you have any other interest in some of the stuff that you've seen kicked around, please let me know. I'll see what I can do to help. And with that, I'm going to go ahead and shut down the recording. Ken, did you want to have any closing comments for the audience before I shut us down?
I would like to thank all of the folks that presented and helped on the conference. This was a labor of love that was accomplished in a very short amount of time. Forgive us for any shortcomings, and let's celebrate the fact that we got all 5 classes in and we had nice big audiences for the whole event. Thank you folks for having an interest, and thank you folks in the back room for helping out and entertaining and educating the people in mid-Michigan and throughout the country. We appreciate it.
Thanks, Ken. Thanks, everybody.
Good night.